good morning. Welcome to another episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is cut. In what must be a cruel joke, markets that have been agitating for a Fed pivot finally got a cut, but not the one they hoped for. Instead of the Fed, it was Fitch. Specifically, it was a credit rating cut rather than a Fed fund rate cut, which triggered the diametric opposite of pivot bets. To be precise, the ratings cut, in contrast to the rate cut bets, resulted in surging USD yields and a stronger dollar alongside soothing equities. Markets struggled to revive risk appetite and all pivot bets, although a second NFP shortfall ahead of steadier ADP headline job numbers triggered a pullback in US dollar and USD yields. Admittedly, softer non-farm payrolls with decelerating job creation at 187K that falls short of 324K ADP, 200K expectations, accompanied by a downward revision of 49K over the last 2 months, dampened rate hike odds. But unemployment rate slipping further to 3.5% and robust wage gains suggest that the Fed's next move is not necessarily a pause. And a cut is certainly not in the horizon. In fact, crude output cut by the OPEC Plus warned of sticky inflation remaining a bugbear. Notably, Russia's 300,000 per barrel voluntary cut set for September, meeting Saudi's extension of its voluntary 1 million barrel output cut, probably speaks of a desire to keep Brent buoyed on the stronger side of $80 to $90 per barrel range, if not higher. What this means is that energy disinflation is set to broadly dissipate quickly. With that in mind, US CPI on Wednesday will probably be the biggest data release on watch this week, given that July FOMC press briefing expressly alluded to a couple more inflation and jobs data as the determinants of the outcome of a live September FOMC. As we have flagged, and as validated after the post-NFP cut down in USD yields and US dollar, market sensitivity to US inflation and jobs data are likely to be elevated. Apart from the CPI, consumer sentiments and inflation expectations from the Uni of Michigan survey on Friday could also feature prominently as markets leave little unturned in projecting beyond a Fed pause to time a cut. In Asia, the RBI in India on Thursday is now in the spotlight, where emphatic disinflation earlier had excited chatter of rate cuts later in 2023. Inflation's re-acceleration to 4.8% in July has hijacked such premature bets, especially in the context of upside risks from energy and food amid El Nino. Crucially, rupee instability risk from a hawkish Fed is a bugbear. Elsewhere, Indonesia on Monday, Philippines on Thursday are set to release Q2 GDP. For Indonesia, the cutback in commodities tailwind will probably begin to show as some deceleration in the growth momentum. Maintaining momentum above 5% could be challenging and at least partly subject to the success of Beijing's ability to revive demand-driven growth in China. As for the Philippines, deceleration to 6% from Q1's 6.4% is more pertinent than the headlines that is at least partly flattered by base effects. In any case, acute imported inflation risk amid El Nino and high energy prices imposing possible rate hike necessities underscore daunting economic challenges. The thing is, cuts abound, but amid heightened uncertainty, not all will make the cut. For more information, please refer to our Week Ahead publication or contact our respective sales desks and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.